Good day, everyone. I am Neshe Timtim, representing to you the accounting cycle. So, in today's video, we will explore the accounting cycle, a vital process that businesses use to record, analyze, and report their financial transactions. So, accounting cycle. In this slides, we will be asked what is accounting cycle and what are the exact procedures to make a correct, informative, and clear financial statements. Before we dive into the details, let's start with the definitions. What is accounting cycle? Accounting cycle, it is a systematic series of steps that businesses follow to maintain accurate financial records. It also ensures the reliability of financial information and aids in the preparations of financial statements. Now, let's break down the accounting cycle into its case steps and explore each one in more detail. Step 1 is identifying and analyzing the events recorded, recording transactions in a journal, posting journal entries to the ledger, preparing the trial balance, preparing the worksheets and adjusting entries, preparing the financial statements, journalizing and posting the adjusting journal entries, journalizing and posting the clean journal entries, preparing the post-closing journal balances. The last step is journalizing and posting of reversing journal entries. Step 1. Identifying and analyzing transactions. During these steps, businesses identify and document their financial transactions such as sales, purchases, expenses, and other monetary activities. It is crucial to understand and analyze its transactions accurately. Example of these transactions. Let's say a business makes a sale to a customer. Identify the details of the transactions such as the amount and the date and the payment terms is essential for accurate record keeping. Once the transactions are identified and analyzed, let's proceed to the step 2. The recording transactions in journal. In this step, businesses recorded the identified transactions in a journal. The journal serves as a chronological record of all the company's transactions. Journal entry for a purchase. For instance, when a business makes a cash purchase of inventory, a journal entry is recorded. It includes the dates, accounts affected, such as inventory and cash, and the corresponding amounts with the transactions recorded in the recorded journal. Then the next steps is posting journal entries. In this steps, it is the process of transferring the information found in the journals to be recorded as a final entry. The journal entries are transferred or posted to the respective accounts in the general ledger. The ledger organizes individual accounts balances. Example for the posting a journal entry through the ledger. When a journal entry for a cash purchases of inventory is made, it is posted to the inventory account and the cash account in the general ledger, maintaining the accurate balances for each account. Step number 4, preparing the trial balance. Trial balance is a list containing the accounts found in the ledger, as well as the accounts balance and the total. And this steps, there are two different techniques, the total method and the balance method. After posting the journal entries, we prepare a trial balance. It ensures that the debits and the credits in the accounts are equal and serves as a snapshot of the account's balances, account balance at specific point in time. Example is this. A trial balance lists all the accounts of balances, including assets, liabilities, and equities, and verifying the debits credits for the balances in the transactions. We will continue the step number 5, preparing the worksheet and adjusting entries. Preparing the worksheets and adjusting entries. The worksheet used to summarize the account balances and prepare adjusting entries to ensure accurate financial statements. For example, making an adjusting entries to record the accrual of unearned revenue by debiting the unearned revenue account and crediting the revenue account. Step number 6, preparing the financial statements. Using the adjusted account balances, the financial statements are income statement, balance sheet, and cash flow statement are prepared. For example, preparing an income statement that shows the company revenues, expenses, and net income for a specific period. Step number 7, journalizing and posting of adjusting journal entries. Adjusting entries made in Step 5 are recorded in the journal and posted to the respective accounts in the general ledger. For example, recording and adjusting entry for accrual of interest expense by debiting the interest expense account and crediting the accrued interest payable account. Step number 8, journalizing and posting the closing journal entries. Closing entries are made to transfer the balance of temporary accounts, which are the revenue, expense, and dividend accounts, to the retained earnings or the owner's equity account. Example for this, recording closing entries to transfer the balance of the revenue account to the retained earnings account and closing the temporary revenue account. Step number 9 is preparing the post-closing trial balance. A post-closing trial balance is preparing after the closing entries to ensure that all the temporary accounts have been closed and permanent accounts have the correct balances. Example, verifying that all revenue, expense, and dividend accounts have zero balances in the post-closing trial balance. The last steps is journalizing and posting of reversing journal entries. Reversing entries are made at the beginning of the new account period to simplify the recording of certain transactions and ensure accuracy. Example, recording and a reversing entry to reverse the accrued interest expense from the previous period by debiting the accrued interest payable account and crediting the interest expense account. And by these all steps collectively form the accounting cycle, it ensuring the accurate recording analysis and reporting the financial statements. So that's all my presentation. I am Neshe Timtim, BSIS 2C for the accounting. Thank you.